In this video, I will show you some secrets of the legendary investor Warren Buffett to help you start investing. Even if you start with a little money and are a beginner, with these 5 steps you will be able to start investing and achieve wealth in a short time. Imagine how it would be to turn $100 into $1,000 or even $10,000 by investing. I'm not saying that getting rich is easy. By taking calculated risks, you can grow your wealth over time. And for those who stay until the end, I will build an investment portfolio with the 5 best index funds for you to invest in today. Let's start. Emergency fund. The first step before you start investing is to have an emergency fund. As the name suggests, this is the money you can access if something unexpected happens. This means you don't need to sell your investments. With an emergency fund, you can avoid going into debt and paying absurd fees. 2 months after buying his first apartment, Oliver had an unforeseen event because the hot water system in his apartment broke and needed to be replaced. Thanks to his emergency fund, Oliver saved more than $200 since he didn't need to take out a loan. When you leave your money sitting in the bank, it slowly loses value. So to set up your emergency fund, you should look for the best savings account. Nowadays, it is extremely difficult to find a savings account that will pay a substantial amount of interest. That's why I look for 2 things. First, a good interest rate. The second thing is having the ability to access my money instantly. Great. Now that you have created your emergency fund, let's move on to step 2. Emotions. Warren Buffett says, if you can't control your emotions, you can't control your money. One of the things that differentiates average investors from quality investors who truly make money and get rich in the market is the ability to control emotions. This difference in mindset becomes evident during market cycles of highs and lows. When the market is high, with everything rising, most investors tend to tell their friends and brag about how much money they are making and how smart they are. They check stock prices weekly, if not daily. Their emotions swing with the market's ups and downs. However, the small percentage of investors who do better do the opposite. These investors are happy when their stocks fall because it means they can buy more at lower prices, knowing that this will result in higher returns in the long run. Because of this concept, Buffett says the market is like a big casino, full of people acting irrationally. They should buy low and sell high, but most do the opposite. Now, let's move on to the 3rd step. Know what you own. If you want to be one of the successful investors, having an edge over other investors and achieving above average returns like 20, 30, or even 40%, then you need to invest in areas you know well. If you are young, it might be gaming, social media, artificial intelligence, or some type of technology business. If you are older, your advantage might be in more mature companies, perhaps insurance, banking, and energy, something of that nature. Warren Buffett is famous for his investment philosophy of investing in what you know. This approach highlights the importance of understanding the businesses and sectors in which you invest, rather than risking in unknown areas. Here are some key points of this philosophy. First, familiarity. Buffett advises investors to stick to sectors and companies they know well. This allows them to make more informed decisions and reduces the risk associated with uncertainty. Second, the concept of the circle of competence. Buffett often talks about this, referring to the areas in which an investor has knowledge and experience. He believes that investing within this circle can yield better results. Third, a long-term view. Buffett's approach involves looking for businesses with solid foundations and lasting competitive advantages that can be held for a long time. Fourth, intrinsic value. This helps you buy a stock at a good price, providing a margin of safety. Buffett avoids complex and difficult to understand businesses. Now, let's talk about one of the main obstacles that destroys the success of beginner investors: the news. Most investors are obsessed with the news, letting it influence their decision-making. The problem is that when you become a short-term investor, you always follow the herd. Remember that if you want to achieve above-average returns, you need to do things that most people don't. That's why Buffett says, only buy something that you'd be perfectly happy to hold if the market shut down for 10 years. Look for solid and perennial businesses and investments that will last for years and years, weathering crises. Warren Buffett concludes, focus on building an investment portfolio that will survive for many years. Remember that the investor's greatest ally is compound interest. Index funds. This is perhaps the best method for those who want to start investing without complications. The legendary Warren Buffett recommends index funds as the best option for new investors who want to avoid many risks and take advantage of market growth. By regularly contributing and investing in these funds, your wealth will grow over time. It is important to note that this is a long-term investment, not a quick way to make money. If you invest only $100 per month in an index fund with a 7% annual return, after 30 years, you would have about $123,000. That is the power of compound interest. Buffett made a bet of $1 million that a simple S&P 500 index fund would outperform a portfolio of hedge funds chosen by professionals over a 10-year period. This bet ended in 2017, and the results were announced. Warren Buffett won the bet, which demonstrates the power of index funds and how an average person can compete with professionals with little or no knowledge. Okay, now let's start with the list of 5 funds for you to start investing in today. First fund, Fidelity S&P 500 with ticker symbol FNILX. This fund is an index fund from Fidelity that tracks the S&P 500 index fund. This fund has been in existence for 5.5 years and has mirrored the performance of the S&P 500 index during this period. The average annual returns of this fund were approximately 9.15% over the last 3 years and 15.81% over the last 5 years. It offers the advantage of zero fees. Most index funds charge fees, usually due to licensing payments to the S&P 500 index fund for the use of its brand. Fidelity resolved this by creating its own combination of 512 stocks to replicate the S&P 500 index fund, allowing them to avoid these fees and offer a fund with zero expenses. Let's move on to the next fund. Second fund, Vanguard Value Index Fund. This fund is a value index fund from Vanguard with the ticker symbol VVX. Vanguard index funds are known for having some of the lowest fees in the market, and this specific fund has an expense ratio of only 0.05%. This means that for every $10,000 invested, you pay about $5 per year in fees, which is very affordable. This fund invests in stocks of large American companies in market sectors that generally grow at a slower pace than the overall market. This means it focuses on large and stable companies, prioritizing stability over growth. The fund includes a total of 328 stocks, with the top 10 holdings being companies like JP Morgan, Berkshire Hathaway, ExxonMobil, and Home Depot. The median market capitalization of holdings in this fund is $13.6 billion, indicating they are large and relatively stable companies. Since its inception in 2000, the return of this fund has been approximately 7.42%. Over the last 5 years, the return was slightly below 12%. A potential drawback of this fund is that by focusing on large companies, they may underperform the broader stock market. However, during recessions, they tend to be less volatile. Now, let's move on to the third fund. This is the Total Market Index Fund. It has different symbols depending on the platform. At Fidelity, it's FZX, and at Vanguard, it's VTSX. At Fidelity, there are no fees or minimums, while at Vanguard, there is a minimum of $3,000 unless you choose the ETF version, which is VTI, with an expense ratio of 0.04%, meaning $4 for every $10,000 invested. Since its inception in 2000, the fund has had an average annual return of 8.2%. Over the last 5 years, the return was 14.9%. Therefore, this is a fund where you can invest and let your money grow over time. The great advantage of this index fund, in my opinion, is that for an affordable price, you get exposure to 374 stocks. Practically all stocks traded on the stock exchange. This provides complete diversification, as you are effectively buying a slice of the entire market. Compared to the S&P 500 index fund, this fund also includes smaller cap companies, making it ideal if you seek exposure to small caps. Therefore, there's no need to add another S&P 500 index fund, which would only complicate matters with overlapping holdings. Now, let's move on to the fourth fund. Let's talk about VGX. This fund is a balanced portfolio comprising 80% stocks and 20% bonds. Essentially, VGX operates by investing in four other Vanguard funds: Total Stock Market Index Fund, Total International Stock Market Index Fund, International Bond Fund, and Domestic Bond Fund. This fund has an expense ratio of 0.14%, meaning that for every $10,000 invested, you pay an annual fee of $14. Since its inception, it has had an average return of approximately 8%, with variations in the last 3 years. The idea is to benefit from stocks while providing fixed income through bonds, as well as including some international exposure in both stocks and bonds. Global diversification can be a prudent strategy, especially if you believe in long-term mean reversion. Now, let's move on to the next and final index fund. Number 5 on our list is VFX. This is the Vanguard Start S&P 500 Index Fund. Considered the gold standard among index funds, VFX has an expense ratio of only 0.04%. Currently, VFX includes large companies like Microsoft, Apple, Nvidia, Amazon, Meta, and Google among its top holdings. Since its inception, the fund has had an average return of approximately 7.97%, and over the last 5 years, it has shown a solid return of 15.76%. If I had to choose an index fund to invest in for the rest of my life, I would probably opt for VO or VTI, which are Total Stock Market or S&P 500 Index Fund.